slides and teaching materials available on Moodle already. Now I will summarize the main content only, and then we will do some like interactive activities like last week. So the first topic we will focus on is non-current assets, and what do we need to remember or understand in non-current assets. In this topic, we will focus on tangible assets, intangible assets, and investment. But mainly, we will focus on the first two, and investment. We just need to understand what are they. So, non-current assets in general, I think that many of us know it already, right? So that is assets that worth a longer period, more than 1 year, and in non-current assets, we need to know two things. First, acquisition cost, and second, cost allocation schedule. So to answer the first one, it means that we will identify the cost of like a certain non-current assets, but for the second one, we will focus on depreciation or amortization. So that's why in this topic, we mainly focus on cost and depreciation. So the first thing I want to emphasize is to calculate cost. To calculate cost, we have a formula to calculate acquisition cost. So in general, acquisition cost, in short, that is all costs that bring the non-current assets, or in IAS 16 focus on property, plant, and equipment. That is a cost that brings the property, plant, or equity available, including purchase price, cost to bring assets, and cost of removing or restoring it. And remember this one, normally, like based on IASB or IAS 16, the cost will include cost of employee benefits arising directly from the constructors or acquisition PPE. So that's the first thing that we about employee benefits, and then cost of site preparation, initial delivery, handling costs, installation, assembly costs, cost of testing whether the assets is functioning properly, and professional fees. So based on this, let's try what the first activities of these questions. That is about acquisition cost, and I launched the poll for you here. And please, can you see the poll? Yes or no? Oh, I can't hear. Okay, yes. Yeah, sorry, because I can see the screen. So now I will share. Is it still on or off? Okay, on. Okay, I will share the slide again, and or if you have slide with you, please have a look at that. So, well, based on we have all costs available to bring things, to bring PPE, property, and plant available to use, and remember and have a look at on the examples whether we will include purchase price. It's so obvious, right? Whether we include import duties, transportation, installation costs, and professional fees. So which one? So please, okay, so it's 1 minute already, 1 minute and 13 seconds. This question, this is at the moderate level for your MCQ exam. So in general, some of you do quite quick, and I will end the poll now. So 70% of you have 134. The next is 109 worth 19%, and then 1 with 100 and 2 with 125. And the answer is 134. In here, we will need to include on purchase price, import duties, transportation, installation, and professional fees. So it's not only include just purchase price, but need to include all everything. And now that's about the first thing about the cost. So in general, based on this example, you can see in short, it will be like purchase price, import duties, right? If we buy plant property or equity somewhere, for example, like in the UK, we buy something in the Netherlands, we need to, for example, like in India, so we need to add the import duties, transportation, installation, and professional fees as well. Professional fees here is relate to like some extra like relate to employees or something. It's add everything into the professional fees. Now we move to the next one, and please feel free to ask me questions if you have any questions. So the first thing, cost of acquisitions. So we finished the first, and now we move to the next one. Will be about depreciation. Depreciations in the book online. I saw all the example there for you. In this on the presentation voiced, I show two main methods, that straight line methods and diminishing balance method. So in this live sections, I also focus on the first two. If you have any questions about the units of production method, you can ask me in via email or during my office hour. So it's the first method about straight line, very simple, right? So we just find the depreciable amount and then we divide the number of years available. So now we will start with an example about depreciation. Okay, start to calculate this. So we will need to identify the depreciable amount divided by the number of years if it's straight line. So the depreciable amount will equal the acquisition cost minus the residual value. Some of you were very quick for the answer. So, and this question is also at moderate level. So you can see this something about calculation is all classified in either moderate or in hard. Yeah. Okay, I will close this question after 1 minute. So 54, 55, 56, 7, 8, 9, 1, I close. So in here, there are 31 votes and 94% got correct answer. That is 1,000. And sorry, I need to share result. And 2 got the answer as 1,200. Again, we need to identify the depreciable amount, and the depreciable amount should be acquisition cost minus the residual value, because the residual value is outside, right? It's not in the value that we will depreciate, because at the end it still have 1,000. So 1,000 not in the depreciable amount. We only focus on the depreciable amount. That is 6,000 minus 1,000, and it's simple, right? And 5,000 we divide by 5, and we have 1,000. So this I show you two questions at moderate level. So they are not very challenging, right? So for some questions like this, it's trying to spend lots of time and then focus to the hard level. Although I mentioned that it's hard, but if you when you have that, you will see that although it's hard, but it's not very hard. That's what I mean. Okay. Now it's simple, and we just move to the diminishing method. In this, we will focus on. Oh, sorry, I don't have. For the diminishing method, the difference in the calculate diminishing method is that we will base on the net book value. That's what I want to emphasize on. And we use the net book value to calculate what the depreciation rate compare with the annual depreciation here. Straight line method, we will use the depreciable amount that is based on the net book value, right? No, the book value that is 5,000 because of depreciable amount. We exclude the residual value from acquisition cost. But for the diminishing one, we will use based on the net book value of each year. I don't know why suddenly I dropped out that part, but we will have a look at. Please have a look at in the book for the example. So in general, about tangible non-current assets, there are two main things we need to look at, or when you analyze about non-current assets of a firm. When you look at non-current assets, what we will see is the total cost they acquired, which items they include in, or which item they should include, but they didn't, right? So that's the first aspect we need to look at when we'll read the a certain financial statement. Another is depreciation. Depreciation for the same firm, not the same firm, for the firms in the same industry. Normally, we expect that they should have similar treatments for all depreciation, for the depreciation method for similar like property, plant, or equipment. But if some firms they use straight line method, it means that they have equal amount every year. But for certain firms, they decide to use diminishing method. So diminishing method at the beginning, they will discount a lot, but at the end, they will discount smaller amount. So when we look at that information, we will see that the expenses at the beginning, when they just buy the PPE, and there are certain PPEs, at that time they will have a lot of interest expense from depreciation. And if they have high amount of interest expense at the beginning, of course, the profit will be like compare with the firms that they use the straight line method, the profit tend to be lower. But we can conclude that to the one with higher profit firms is better if everything constant and only the difference in the depreciation method, right? So therefore, we need to read accounting policy. And for accounting policy, we analyze further in different aspects to see we can't conclude manipulate or not. We just can conclude that depreciation is an aspect that they have different treatments. So it's not affect the final conclusion about profit when we compare between two firms. That in the point I want to emphasize, because we learn financial reporting and interpretation. Now we move to another topic in non-current assets. So we learn about tangible assets, and now we will move to lease. Leasing is another topic of tangible non-current assets, and especially we see a lot of lease in airline industry. And if you pick up firms in airline industry, we should know about leasing. So what in general in software leasing, or what is a lease? A lease is when at the beginning they affirm they don't have they don't have PPE, or they don't have an airplane, but they will like kind of they sign a contract to lease, and to lease it means that they will use an airplane, and at the end of the contract, they every month or no every year or maybe month they will pay certain amount, and at the end of the contract, either depends on the type of contract, operating or financing. Based on that, they can take the airplane in or with the airplane, or maybe at that time they will return the airplane to the seller, or like Boeing or any companies, for example, like even Rolls-Royce, right? They also produce airplanes. Sorry. So when we analyze a certain industry, what certain industry they have a lot of like they have certain items that we need to look at, and therefore now I mentioned about lease for you to understand why is it. So lease, in a lease we have lessor and lessee. Lessor is the one who give the right to use, and lessee is the one who received that right, who got the right to use the assets. So when we record, normally for all leases, we should include in statement of financial position. But for some lease worth less than 12 months, or the low value, or maybe covered by other standard, we don't need to record in statement of financial position. So let me take a simple example about this case about less than 12 months. If we sign a contract to buy an iPhone worth Apple, so we have a right to use that, right? And then every month we need to pay a certain amount. So kind of this is a simple example of lease, that we have a right to use that. Apple give us a right to control, and then we can do everything with that, or my mobile phone companies also give with different companies that we sign contract with. But so every month we pay a certain amount, and then at the end we got the phone. So that is a lease, that's an example of a lease. But whether we will record or whether Apple or mobile companies that will record as a lease or not, the answer is no. Why is a no? Because the value is low, right? Or if we pay, for example, like within 6 months we got the phone, so it's also not subject to lease. But that is a simple example of lease. But we don't record because small amount. But if large amount, we will need to record, and longer than 12 months, we need to record. Okay, so what you will need to know in this lease is the right to use and the obligation to make payments. For so that you in finance, you know that we as an example that we buy something and we pay certain amount in the future. So how can we record the value on financial statement? Of course, we need to find the present value of that. And in a simple way, we will discount all the future cash flow to the present to identify the present value, right? So the present value, that is the amount that we need to record on financial statement. However, the right to use and the obligation to make a payment, that is the liabilities, will different. What is the difference in here? The right to use, you need to include all the payment that you pay in advance, right? So like if you buy, now take a simple example from iPhone. So we make payment, we just pay at the end of each month, but at the initial point, we need to deposit a certain amount of money. And if we deposit a certain amount of money, discount on the present cash flow in the future to the present, the total amount that will be recorded in the right to use and will record as an asset, okay? And that will lease will record that as an asset because we pay the certain amount at the beginning already, and all the future, all the payment we need to pay in the future is reflected in right to use. But how about obligation to make payments? Obligation to make a payments also the future point, right? We need to pay certain amount in the future. We discount back to the present, but whether it's capture the initial amount at the starting point or not, no, because we paid it already. Therefore, we still discount the present value to the future cash flow to the present, but we exclude all the amount that we already paid. Two way very comparable, but kind of a little bit different. Okay, so right to use will include all the initial costs, but obligation to make it or to pay it will be will only count after commencement dates, mean that on the future cash flow. The example about this in the book, and also I will open the supplementary questions for you to practice, and this will be in the hard level because lease is not an easy topic. So I'm sure that with your finance knowledge, you will be able to cope well with this topic. So please practice it by yourself. Okay, so just understand the underlying idea. And one more thing I want to emphasize on this is, although we record assets at all the initial costs that we pay and the present value of all cash flow that we need to pay in the future, but the total amount that we need to pay is the amount that we actually paid, right? So like if at the end of year one, we pay 100. At the end of year two, we pay 200. So the total amount we pay, for example, at the beginning, we don't pay anything. So the total amount on the total payment is 200. The total payment different from the present value. For sure that you know that, right? So for any, like we pay mortgage, the total amount every year is that the total we pay, but the present value different from the total payment. That's what I want to emphasize. Okay, so do you have any questions about this? This is in the hard topic, but it is useful for you to understand when you analyze financial statement. Understand about whether firms control that lease or not. Okay, and or maybe for lots of activities, that lease is a very common topic, and I will introduce or analyze some firms for you with lease in financial statement analysis course. I think that you will see me next week on this, but in other course. Okay, so now we move to intangible assets. Intangible assets is an identifiable non-monetary assets without physical substance. That is the definition. So there are three characteristics we need to know in intangible assets. That must be an asset, right? But is non-physical substance. So intangible, we can't touch, but it's need to identifiable. Identifiable is that we can identify it. So what does it mean in here? Let me take an example about identifiable. Identifiable is that we need to separate or is arising from the contractual or legal rights. A simple example is brand name. If that is, we need to know that it should be separate and arising from a certain rise of contracts or something. So with brands, if brands is inside the firm, right? If say one of the most valuable brands is that like Apple. We know that is the value they value the brands a lot. However, whether Apple can record brands at their assets or not, is the answer is if there's no transaction in based on the brands, of course, Apple can record it as intangible assets. Although although outside market can value the brands or something, but if can't separate by any transaction, we can't record it as an intangible asset. Okay, so it must be, there should be a transaction. So when will we know the transaction? Of course, when there's M&A activities, like when there's M&A activities, when one firm acquired another firm. When when one firm acquire another firm, we always have like an investment bank, right? An investment bank need to like value firms, and then they will over like any about M&A symmetry or something, and then they value a higher value than the true value, and the difference between the higher value than the true value, they said that because it's include brand name, and at that time we can record the value of intangible in that, or goodwill as an example. Okay, I see a question. But do we need to remember those numbers such as IFRS 9 or 16 or IAS 16, 38? Do this will be tested in the exam? In the exam, it will not be tested. So it's okay that if you don't remember, but if you remember, it will be better. But yeah, we don't ask you what's the name of intangible assets like IAS 16 or IAS 38. No, you just need to understand the idea of the topics, because this is the course for finance student background. Yeah, you're welcome. Another topics we need to know in intangible assets is research and development. Why we want to introduce this to you? Because at the moment, this is the growth period of a lot of technology firms, a lot of biological and technology firms, and we can see that during this period, right? And so when will we can record research and when will we can record development? We need to separate research and development stage. Research is just the step to see happen, and when they're successful to they're successful to say that, oh, so finally we find a certain drug that now now we will treatment stage. So when you develop that, they record technology firms or even IT firms. They got a lot of expenses, but they record as research and development. So even research and development account a lot in expenses. It doesn't mean that it's not good. It's just because that firm in that industry and that firm can be in the development stage. Oh, sorry. Can you hear me properly? Okay. Sorry. If you can't hear properly, please feel free to let me know. Okay, now we talk again about research and development. So therefore, when at the research stage, right? So we don't know whether it's successful or not. We need to record at research stage. But when the things a certain type of drugs, or they go through different stage. They will go to trial stage, phase 1, test, phase 2, phase 3. If you're interested in biological firms or value in biological or pharmaceutical or even technology firms, I think research and development is really an important part that you should have a look at. But if choose firms, just choose a normal firms. Don't choose some growth firm with negative cash flows or negative cash flow or negative profit to analyze, because that's advice also apply for your financial statement analysis course. If you choose some very interesting firms, for example, like at the beginning of the course, I introduced about block power. It's very interesting to see that negative profit and negative cash flow, but still increase a lot. So if you choose some special firm like this, we don't have PPE to discount, and negative cash flow, we also can identify the positive cash flow in the future to discount back to identify based on DCF model, for example. So therefore, choose a normal firm, a traditional firms, not in the growth firm, but it's important to understand. Okay, so so why it's important, as I mentioned, research cost is in another state and development cost in another state, and research cost always need to record as expenses. However, when moved to development stage, this development cost will record as assets, and once it's recorded assets, how about when we record research and development stay on the financial statement? If we got research and we got development, and development already moved to assets, that development cost need to amortize or depreciate, and we still need to record the depreciation in the financial statement, in the statement of profit or loss or income statement, right? So therefore, the total cost of research and development will, if we record expenses, it will either include research and development. If development at that time, they will also say, oh, not successful, and research and development is still everything in the R&D in the research stage. So all need to be recorded as expenses. But one, we can split between research and development. Remember, need to record research costs as expenses, and depreciation form the development cost as expenses as well. Okay, so that's the thing we need to know. Now we will revise a little bit about intangible assets before we move on, especially about research and development. I will launch a poll and you will start to read and do it. So how should research and development expenditure be dealt with in an entity's financial statement? Okay, I will start to end the poll. And we'll share with you the result in here. This is a little bit tricky with the last two. When we record research and development, we need to written off always, right? We need to written off the research expenditure as expense. And for the development expenditure, as I mentioned, we know that it's in development expenditure, but if it's not satisfied, it's not completely finished or something, or can't be able to complete even in the development stage, it's still in the R&D as the expenditure. So, or as expenses. So therefore, when in the development stage, but need to be sure or complete, or need to be able to complete and say that from now is in development stage, like for example, Pfizer, or like yesterday, no, not yesterday, but in the midnight or early morning, like Novavax start to another vaccine company mentioned that their vaccine effective 89%, and now they can start to produce. So from this day and until that like the share price of Novavax increase, and that's positive news. But when they announce that it's effective, it's passed, and then can start to deliver, it means that they can start to complete and can be in the development stage, they develop more or something. So at that stage can recognize as an asset. But if not complete, but still test, and then finally that we test, we in the development stage, but then unsuccessful, still in the expensive stage. Okay, so therefore, under US GAAP on R&D expenditure, they put in the they put everything in expenses. But in IFRS, we can split between research and development, and therefore we need to, when we read financial statement under IFRS, we need to know whether certain firms they classify development is correct or not. But under US GAAP for US firm, we can see that they all in the expenses. So it's not very challenging. But for IFRS, development stage must be satisfied all or certain conditions. So therefore, 27 people got the correct answer. And thank you for the 5 questions, 5 answer with 15% for me to explain again. And yeah, be careful what the capitalize the intangible assets. Okay. Now brand names, as I mentioned already, brand names is internally generated, and everything internally generated, we can record it as intangible assets, and we can only record brand name when it's acquired from another company. So finally, about investment. What do we need to remember about investment? Investment will relate to financial assets, about financial liabilities. When we read financial statement, you can see financial assets or hedging or something. It's all about investment. So for investment, for financial investment, what we need to remember is financial, right? Because it's about financial assets, so the value will change. Normally, we will focus more on cost, and when we focus on cost, the financial investment of financial assets, or in general financial investment, we don't care about depreciation, but we care about whether financial assets or financial liability is recorded as acquisition cost or as fair value. So what is fair value? In a simple way, fair value is the value that we use to trade. So when we use to trade from one, like a house, right? we see at the moment how much is it, so it means that is the fair value. We don't base on the historical cost, but we see how market value it, and the fair value is when one thing is streamed by another thing when buy or sell. So when will be recorded as an acquisition cost, normally we record an acquisition cost, but financial for some financial assets that don't use for trade, not available for trading, okay, it can be recorded as fair value, but that value need to record in other incomes, other comprehensive income items. However, for financial investment that are valuable for trade, something that is in the like kind of active stage that available for trade, we need to record it at the fair value, and the gain or not from that we will report in the profit and losses statement. So if record at fair value, we have two types. If it's actively traded or like held for sale or like available for sale, it should be in recording profit or losses statement. But if not active for trade, it should be in other comprehensive income. When look at financial statement, see financial statement, when you read it, right, you look at financial statement and see financial assets or financial investment, see if it's in the comprehensive income or in the financial position. In the profit or loss. So it means that in the upper part, right? If it's upper part, it means that it's in the stage that firms will maybe that financial assets will are trading or will be trading at some point. But it's in the item of other comprehensive income. It means that financial assets or financial liabilities in the state not available for sale. Okay, so that is about investment. So recognize in income statement. So to sum up for the first part, so for the first part of our lesson today, we learned about non-current assets. And then in the non-current assets, we have three topics to remember. The first one is about PPE, right? It's IAS 16, but if you don't remember, it's fine. And the second one is intangible assets, and the third one will be financial investment. For the PPE, we need to know acquisition cost and intangible assets. Depreciation, right? For the for the cost, acquisition cost, that is the cost need to bring PPE available to use. So it include everything, include purchase price, import tax, include transaction or transportation costs, include professional fees paid for the setup or everything. So that's the first part. The second part about depreciation. Depreciation, we have two methods, and it's quite simple to remember. One is straight line method. We base on the book value or depreciable amount divided by the number of years. For the diminishing, we base on net book value times with the diminishing rate. And one point I want to remind you, but let's play a little bit, and then I will. Start with this questions. Which of the following tangible assets cannot be depreciated? Okay, 30 already, so 40. I can see that some of you very quick when you see the question. I will stop in 10 seconds. Building equipment, land, and vehicle. Building got one choice. Land got 34 and vehicle got 3. So vehicle should be classified as property, right? Or comparable with property. Building a little bit tricky. And the answer is land. Yeah. So how can we know that whether it can be depreciable, can be depreciated or not? We just need to know that if something got finite life, we can depreciate. However, if something, or especially like land in here, is indefinite, so we can't depreciate. And there is a point that I want to emphasize to you. Sorry, I forget to share. But remember that land is indefinite non-current assets, therefore no depreciation. Okay, so now we move to another topic about refining the accounting system. Sorry, I just stopped at the first one, right? Another topic I want to focus is intangible assets. Sorry, I summarize intangible assets. Intangible assets that is that need to meet all the definition of assets. However, is we can't thought is intangible. And what we need to remember about intangible assets, that is first, research and development. For research and development under IFRS, we have 2 stages, one for research and another development. And if research need to record all as expenses, however, development can record as expenses or capitalize as assets, but it can only capitalize as assets if it meet the certain conditions. That is, need to be like kind of certain, need to be able to use, meet available for use. Okay, so that is about R&D and internal generated assets. When we think about internally generated assets, for example, like brands, we can only record it as intangible assets when there's the there's acquisition. At that time, we can value. So that's it about the intangible assets. Now we move to the refining. In the refining, the accounting system, we have accrual and prepayments. So this, I think this graph is quite useful for us to see. For expenses, we have 2 types of expenses. One expenses that already incurred, but another expenses not yet incurred. So if already incurred, but we haven't paid yet, we will record as accrued expenses. But if it's we paid but not yet incurred, we will record as prepaid expenses, right? And prepaid expenses we will record in the as assets in the statement of financial position, and the accrued expense as we use already but we don't pay yet, so it will be in liability. And for revenue, we also have earned and but not yet record, and another is record but not yet earned. So what does it mean between these two? Sorry, I should have a line here. So earned but not yet record, it means that we sell but we don't receive but we don't record already in the financial statement, or we don't receive cash yet. So it will be as an we record it as revenue, and and we also record it as an asset, right? For the record, but not yet. And so someone order something, but we haven't deliver it. So it's as the liabilities because we received the money, but we haven't uh, delivered the service or revenue yet. So it's as liability. Now, provisions. Remember about provisions, contingent. So what I want to emphasize in here is quite important to remember. Let's look at the symbol here. So if liability is real and is present already, so it's based on the past obligation and it's real, it's happened already. The timing is certain. So as it happened, we know when it happened. So it's certain. And the amount of that liability also certain because we need how much we will pay. So that is called liabilities. But accrued liabilities is, yes, it's at the moment subject to the present obligation, but almost certain. It means that the timing here is almost certain because we know that, oh, okay, like example of accrued liabilities, like an right? So we know that it's happened, but we can't conclude that or how much we need to pay for a certain service because they may say that, oh, maybe you need to pay more or something. So it's almost certain about timing when it's happened, but it's uncertain about the amount. What's the provision? The provision is, in short, that is an obligation. That is the liability, but we don't know when it's happened and how much we need to pay. So that is an obligation. That is the provision. But the contingent liabilities, we're not sure whether that is the obligation or not. We don't know when will it happen. And we don't know how much we need to pay. But like we in the situation that we guess that it may happen. So why we need to distinguish between these 2 points, the last 2 points, provision and contingent liabilities. When a firm record provision, they need to record as a liability in financial statement. But when a firm, they just record it in a contingent liability, so they don't need to record as liabilities. And when they don't record liabilities, they just need to make a note to financial statement. Therefore, note to financial statement important to read, but sometimes it's too long for us to read, and then we may ignore it, right? Or we may ignore some point. And because of that, like kind of behavior or our behavior, and we ignore that information, and therefore two firms kind of quite different, right? Firm with higher liabilities because of the provision, but another firm lower liabilities because of the contingent liabilities. And therefore, we need to identify, and if in the contingent liabilities, we should consider about this, whether there's a possibility that this contingent liabilities will turn out as the liabilities in the future or not, right? And if it's turn out as liabilities in the future, it means that when we forecast in the future, we may think or we may concern about the performance of firm in the future. So that is a reason why we should know how to distinguish between provisions and contingent liabilities. So in short, provisions is an obligation. However, it's uncertain. We don't know exactly about timing and amount, but that is an obligation. But contingent liability is no present obligation. It's just a guess. Oh, we received something, but we don't know. Oh, so whether it's happened or not. So it's just no present obligation. But if we think that oh, it may happen, so we need to note in the financial statement. So that is the sum up of our provision and contingent liabilities. And to make it longer, I think this decision tree is useful to see. Like if it's present, like that is the present obligation. It's probable outflow. Yeah, maybe up. Yeah, probable. It's happened in the future. So of course, in the future, need to have outflow. Reliable estimate. Yes, maybe, but we don't know. We don't know the amount we need to pay. But that reliable. That information is reliable. Okay. Although uncertain, we don't know when we need to pay, how much we need to pay, but that information is reliable. Okay, so that's the point. Need to distinguish about uncertain and reliability or a reliable estimate. So if it's probable, we need to pay reliable. We need to provide the contingent. But if it's present obligation, we're not sure. But okay, we may still think that okay, this may happen. We can record as the contingent liabilities. Another case is yes, it's this will happen at some point, but we're not sure about whether we need to pay or not, or whether the estimation reliable or not. Can record as contingent liability. Okay. So now we will do a little bit about case one here. Please read this and what will you do? What's the pending to litigation? Is it probable that Omega company will pay a fine? But it's still waiting for the final decision and the amount is unknown. So since we have three options. The first one is no certainty, so do not recognize, do not disclose. So it means that don't do anything. The second point is as the payment is probable and recognized, so it should recognize as the provision. And another thing is should be disclosed as note, so it means that should recognize as contingent. Okay, so this it is 100 days. So sorry that I will keep you for a while today, like last week. Okay, I will stop in 5 seconds. I'll stop here and share the result for you. In here, 10% think we will not do anything. No contingent liability, no provision. 30% think that should be provision. And 60% think that it should be contingent liability. Right? So what's the correct answer? The correct answer in here is read this. It is probable that it will pay a fine. Still waiting for the financial decision and the amount is unknown. So for sure that this will happen, right? And because it's for sure that it will happen, it's certainly that it will happen. And therefore, in this case, based on a more based on prudence or conservative, that we need to record as provision, right? So the correct answer in this case is we should record as provisions based on accounting standard. But for 60%, there can be argued that, or It's just probable, but we don't know anything. We're still waiting for the amount, so it should be in contingent. That is many many people argue about that. But in general, although that we don't know the amount, we're still waiting for the decision. But the amount, the decision from the court is reliable, and because it's reliable, it's in the provision. Okay, so therefore, the correct answer is should record as provision. Now we move to another case. Case 2, shorter and simple. Directors decided to close down one of the company's operations, and this would involve redundancy of 250,000 thousand. On 31st of March, until the end of the month, the decision had not been announced and had not yet been acted. So provision or not? Now it's just provision or not, right? So you can see the way to classify provision or not is quite subjective. And because subjective, therefore firms can tend to choose to classify as provision or contingent. And this information is important to understand. And to see whether a firm is conservative or not when you analyze financial statement. Good. Let me close and share. Very interesting result that 50-50. 50% of people think that yes, it should be recorded provision. Another think that no, this is not a provision. So what is the correct answer? The correct answer in this case is that no, that is not a provision. Why there is not a provision? Let's look at the case again. On the 12th of March, director decided to close. So it means that they decided to close already. And there will be a cost of 250K, right? But until the end of the period of end of March, the decision had not been announced and had not yet been acted upon. So nothing happened. We know that they close, they may close, but we don't know whether it will happen or not. So it's there, but not sure. So it means nothing at the moment, right? And if nothing at the moment, no obligation to pay 250K. And although we see the amount there, but the starting point is that it's not at the moment. It's not happened yet. They don't announce anything yet. And when they don't announce and they had not yet been acted anything, so it means that they can withdraw the decision. And when they can withdraw the decision, so no provision. But if in a similar case like this, but at the end of the month, the board already announced. And if they already announced, right, so it's happened, and the 250K there, they will need to prepare for the future or to pay for the staff in the future. So it's in liabilities, and therefore need to record a provision. So the starting point to identify provision or contingent is whether it's at the moment, whether it's present or not, right? That's the starting point I want to emphasize. So it must be the present obligation. It must happen. It's happened. And if it's happened, then we will see that whether it's probable in the future that we will need to pay a certain amount. And if that amount can be uncertain, or we don't know any time, but we know that in the future it will go out, and the amount is reliable. We will need to record a provision, otherwise in contingent liabilities. Yeah, so that's what I want to mention about contingent liability and provision. It is important to read, to analyze financial statement, to read in notes, to see that where the firms have any provision that it can happen in the future. And normally, what type of firms they normally record more provisions? The firms normally in the state of like they're more conservative. And what type of conservative firms? And again, I want to mention about prudence. I'll repeat for the first one. The prudence is that they will not overstay assets or revenues, right? Or they don't understay expenses or liabilities. So it means that they should have smaller amount. So what type of firm will be like that? The firms that they need to raise capital from debt market, because banks or lenders, they prefer conservative firms. And when banks, and from your aspect as a banker or from lenders, you see that firm, they predict, they project or they forecast something happen in the future at provision already. And when they add the provision and already they subject, they deduct all the costs, they record it already. So it means that okay, at there is the worst case that it may happen to your firm, but you still have a loss of cash. And then from my side, as bank side or lender side, I feel or increase the creditability. I feel more reliable on your firm. So that's why for the firms that they target more to, or they focus more on credit side, or they want to raise from banks, or they use private lending, they will record more provisions, or they will choose more conservative way. But conservative way is normally market or as investor, right? Investor don't like to see some negative cash flow, or don't see don't like to see low profitability, right? So that two sides of capital structure from investor, equity holder, or from lenders. So when we read financial statement, when we see all the items, we can see what type of firm in, and depends, and it also depend on your what side that you want to analyze. You act as bank or lender, or when you look at from credit side, or when you look at from equity side. Okay. Yeah, that about provision and contingent liability that help us to understand more about firm. I think let me see whether we have anything that I want to focus on. Okay. Another thing I want to focus. But do you feel tired, or do you have any plan? Because it's outside of our schedule already. Are you happy to continue or not? Please type in the chat box for me. If you feel like it's enough, and then maybe I will continue with this in the next section. Okay, unless I receive a chat that continue. Okay, so let me continue with this topic. Try to finish this for you, and then in the next one we will move to another topic. Thank you for your patience. Now we will continue our topic. Okay, so we finished with to distinguish between liabilities, accrued liabilities, provisions, and contingent liabilities. Now we go to another topic that we should know is impairment testing. So when will we record impairment? When there certain problem with assets or in general, like tangible assets or intangible assets, so some the value and suddenly that like we buy lots of inventory, but then suddenly something happened with the inventories and then they destroy, and then the value of the inventories decrease, and therefore the value at the beginning when we buy the inventories compared with the current price of the inventory is different, and at that time we need to do impairment, right? We need to record impairment. So in short, at the end of the period, assets that need to review for the indication of the possible impairment. So how can we know that? As I mentioned, right? For example, inventory, we need to compare at the beginning, and then we see that what happened. So we see the carrying value and the recoverable amount. Carrying value is that we think that at the moment the value is something like that. However, when we test it, we check for the value of the certain assets, we see that the value at the moment is lower than what we think is the carrying value. And if it's lower, we need to record. And how can we identify the recoverable amount? The recoverable amount is a higher value of fair value less cost of disposal or the value in use. And the fair value, as I mentioned, that the value that we use to at that time we sell a certain assets, and that the value that we can check, right? But if we keep that, right? If we keep the assets, so we need to use the fair value less the cost of disposal, that the value that the money that we need to pay if we sell it. So the recoverable amounts will be the higher value of fair value less cost of disposal or value in use. Value in use is just the present value of the assets. If the assets, when we buy a certain assets, and we think that in the future every year it generates a certain cash flow. It's a very common exercise for you in corporate finance, that we buy certain assets and then we think in the future it generates a certain amount of every year. In year one it generates a certain amount, year two a certain amount. So value in use is the present value of own cash flow of that assets generated in the future. So we compare between value in use and the fair value of less cost of disposal higher, we choose that as the recoverable amount. And if the recoverable amount here higher than the carrying value here, we need to impair. We need to record an impairment. So when you look at into financial statement, you see impairment of something. It means that certain assets got lower value than the carrying value or the value that they expected. And so what happened if carrying value is lower than the recoverable amount, right? Sorry, if the recoverable amount is lower than carrying value, if the recoverable amount, so it means that the true value of the assets lower than what we think, we need to do impairments, and impairments at that time we will record as the loss. So it's recorded as impairment loss. And you can see in here I use two sides here. Reduce in assets means that the certain amount is reduced, right? The value of that assets will need to reduce, and equity here reduce because we record it as expenses. And when we record as expensive, in general, at the end, the equity will lower. So it's reducing equity as well. That is about impairment. And finally, about bad debt and doubtful debts is another topic that we will look at. Bad debt is the amount, I just explain in a very short way, that bad debt is amount that we for sure that we will not be able to collect anymore. So it's bad debt. But doubtful debt is the amount that we just doubt. We just think that, oh, maybe we will not be able to collect, but maybe we will be able to collect. So we just doubt only, right? So that's the difference between bad debt and doubtful debt, and don't mismatch that between two. And if we want to calculate and how to record it, because here is we something that you see that bad debt or even doubtful debt, we think that we cannot collect it in the future, and it will relate to trade receivables, right? And trade receivable is an asset, but we can collect in the future, so we just need to reduce the trade receivable. And the amount make trade receivable at that time, so it means that it's reduced and we record as expenses. So bad debt or allowance for doubtful debt, we record as expenses here, reduce the profit, right? Because it's reduced the profit in the income statement, and the receivable, the trade receivable on the statement of financial position also reduced. It's the same idea for allowance for doubtful debt. It's also reduce the profit because we recorded expenses and trade receivable lower. So that's it for the topics today about the refining. Yeah. Could I briefly explain? Okay, I want to briefly explain the difference between provisions and allowance. Okay, provisions, as we see before, right? Provisions, something that we just use, we predict something. In general, allowance is a kind of a part. It's named as the provisions because we predict that, or maybe in the future it's reduce the value of trade receivable, but it's not classified in the provision part because the provision is a liabilities, right? A liabilities that is at the present, it's happened at the present, but we need to pay in the future. But allowance for doubtful debt is it will affect the trade receivable, right? It's reduce the value of trade receivable. It's not about our obligation to pay in the future. We record we call it as the provisions for doubtful debt because that's something we concern. That a name, it is a name that the provision, and it's concern, and it's kind of conservative way or prudent way, and it's reduce the value. And that's why although the name of the provision for doubtful debt or bad debt is like it's kind of weird. We see the name of provisions, but it's different. Provisions in the term of obligation is the obligation we need to pay. But if for allowance for doubtful debt is someone will not be able to pay for us in the future, right? And we just record it as an item to make the statement kind of more conservative way. We don't overestimate the value. Yeah. Is it clear to you? If it's not clear, I will try to find a simple way to explain to you. Do you have any questions? Okay. Do you have any questions? Sorry to keep you quite long. So you can see that there are a lot of things in this course trying to approach from finance for you, that you don't need to prepare what kind of like we call debit or credit or something, but we need to understand items in accounting to analyze, right? To read, to be able to read financial statement. And next week we will learn. We will start 1 p.m. instead of 12 p.m. like today. So all the topics in Unit 2 will start at 1 p.m. And when you move to Unit 3, this will be at 12 p.m. again. Okay. And I can see that all of you got groups already, so you can start to think about a company. But you will be able, or if you want to do, if you have certain knowledge about that topics already, you can start to do with that. I also I posted the guidance for the group assignment already, so you can have a look at that. It's quite different from the assignment in the what financial statement analysis course. Okay, so please follow the structure, and we will learn that topic in lecture 5. So at the moment, just pay more attention to all the technical part of Unit 1 to understand Unit 1 first, all the items in that, and try to have some quizzes. I already prepared some quizzes for you to do more quick quizzes, but I can't cover all of that quizzes in this live session. We will review that and summarize of Unit 3 again in the next one. And I'm sorry for delaying the summarizing the whole topics, no, the whole unit, because the plan is I should summarize. But hopefully for every live session so far until now, for each section you know the main content. Okay, so do you have any questions? If you want to ask something, please feel free to ask me. Yeah. So thank you for attending the live session today, and I will see you next week. And remember at 1 p.m. next week. Okay, and have a nice weekend. Yeah, thank you. Bye.